Hi, I'm Corey Litzenberg of CGL Strategic Business and Tax Advisors, coming at you a little more informal today. Had a little bit of a server issue during tax season, so while my IT guys are dealing with that, I'm just working on my computer and decided to record a quick video. So what we're going to talk to you about today is business use of home and the capital gains exemption related to principal residence. There's been a little bit of stuff on social media. I've commented about it, probably a little more emotionally than usual because of the misinformation that's been going around. But I thought I'd clear the air and let people know a little bit what's going on here. So, thanks to the mindless ramblings of a misleading politician, there's been a lot of talk this tax season thinking that people will lose the capital gains exemption on their principal residence if they use a part of their home for a business purpose. So before I continue, let me be clear. Yes, you do have to report the sale of your home on Schedule 3. This year is the first time that they've implemented that. It was an administrative relief provision before that you didn't have to report it. However, now, yes, you do have to report on Schedule 3 even if you owned no other property before. However, it is a strictly information-only reporting. It's mainly to draw people to start reporting when they sell their home. The information you are reporting is very vague. It's very basic. It's the address that you sold, the year you bought it, and what you sold it for. That's it. So my educated guess is that they're trying to crack down on the house flippers, the ones that on those home rental shows that buy a home for cheap, live in it while they renovate, sell it. If you do that once, probably won't attract much attention. It's probably just luck, timing of the market, whatever. But if you do that repeatedly, you're likely engaged in a business activity, and that's a whole other topic for a whole other day, because you'd be putting yourself at risk for a lot of things if you're not reporting income from that. Regardless of that, the rules affecting everyday home-based businesses have not changed. Put it in layman's summary for those of you who don't want to watch the whole thing. If your business is primarily based from your home, you can claim a percentage of your expenses based on either square footage or number of rooms for the space used principally in your business operations. So you already have probably been doing that for business use of home. If it's a small amount, 10% under, you're fine. I wouldn't lose any sleep. Just don't claim any depreciation on your home and you'll be fine. No issues there. But first, let's get into a little bit of the benefits of business use of home as to why you'd even want this. Now, it's kind of I know you're sitting there, Corey, I want deductions. It's staring at me right in the face. But with some of these, some people might be a little afraid of what's come out recently as far as these things, and they're now concerned that they've jeopardized their exemptions. But let's back up a step. So one benefit of having a home office as your main place of business is that it satisfies the test for the deduction of home expenses, which is under subsection 1812 of the Income Tax Act. The only other way to claim home office expenses is to establish that the home office is used exclusively for business purposes and is used regularly and continuously for meeting clients, customers, or patients. That's a much more difficult test to meet. So if your only place of business is your house, that's the easy part. If you have other places of business, you now have to show a little bit more in depth as to what is being used, that you're regularly meeting people there. So that makes it a little tougher. A second benefit of having the home office as a principal place of business is that travel expenses from the home office to another place of business, that is commuting expenses, are deductible from business income. This was actually confirmed in archived interpretation bulletin IT 521R, paragraph 24, and upheld in a Tax Court of Canada case referred to as Montperus. I probably butchered that immensely, so I'm going to just put it up on the screen. But it was in 2010 Tax Court of Canada. The number is 2010 TCC 172. In Jenkins versus the Queen, another Tax Court of Canada case in 2005, the CRA had denied the deductibility of home office expenses to a fisherman on the basis that his boat, not his home, was his principal place of business. The court focused on the question of where the business activities, invoicing, payroll, etc., took place, and concluded that the boat was not a place of business, much less the principal place of business. The implication of this case appears to be that a home office could qualify as a principal place of business even if some of the business activities take place elsewhere. Paragraph 2 of that same interpretation bulletin IT 514 which has been archived, supports this view and uses the example of a contractor and farmer who have home offices as principal places of business. What are the cons of a business use of home? Well, if you use a substantial portion of your home for business purposes and or you claim depreciation, also known as capital cost allowance or CCA, on that portion of the home for the business, you would be opening yourself up to taxable capital gains and recapture issues, also known as income, when you sell your home. This is not anything new. For most home-based businesses, they likely won't claim depreciation. In fact, most tax software providers won't even put the line on the business use of home expenses just to protect you from doing that accidentally. So they keep their principal residence exemption based on when they sell the property. When you must be careful is when there's a substantial part of the home being used for business or rental income. So, for example, a large bed and breakfast business in a home, or a house converted to a permanent daycare where basically there's nobody living on site anymore, or maybe just in one room, but everything else is the business. You might have some issues there and could jeopardize the principal residence exemptions. The CRA uses an example where a taxpayer owns a home and rents out 40% of the property. This shows that the taxpayer would have to pay tax on 40% of the gain when he sells the property because 40% of the property was income producing. So just be aware that obviously the CRA is saying 40%, that's a substantial amount. So they've come out and said that on their position at this point. Administrative relief. So how about most home-based offices? What about those? So many of them, from what I've seen, use less than 10% of their home as their home office. CRA likes to define the term all or substantially all as being greater than 90%. So by that same definition, you should be able to argue that if you use less than 10% of your property for business purposes, that means that all or substantially all of the home was personal, and therefore you should still be exempted from gains when you sell it, provided of course you didn't claim any depreciation. The CRA confirms this administratively in their portfolio, S1F3C2, because apparently we don't want to use words anymore, in paragraph 259 and 260. It says, it's the CRA's practice not to apply the deemed disposition rule, but rather to consider that the entire property retains its nature as a principal residence where all of the following conditions are met. The income-producing use is ancillary to the main use of the property as a residence. There is no structural change to the property, and no capital cost allowance or depreciation is claimed on the property. These conditions can be met, for example, where a taxpayer carries on a business of caring for children in the home. So your day home providers, you're probably okay, which a lot of people are probably concerned with. If you rent one or more rooms in the home, so you've got a couple people renting bedrooms. They're not renting the house, they're just renting a couple rooms, you're probably still okay. Or if you have an office or other workspace in the home which is used in connection with a business or your employment. In these and similar cases, the taxpayer reports the income and may claim the expenses other than depreciation pertaining to the portion of the property used for income-producing purposes. But as soon as you claim depreciation on your home, you fall out of any potential for relief. So is 20% still okay? Because we've said 40% is not good. 10% is probably good. Where's the cutoff? Well, it's not likely common that you're going to have a one-person home office is going to use more than 20%, unless you're a very small home, because obviously the smaller the residence, the bigger the office probably takes in space, and so percentage-wise it would be bigger. For example, if you have a 5,000 square foot home, I'm guessing you don't need a 2,000 square foot office. Okay, so while not likely common for home office for one person, there are court rulings dealing with the definition of all or substantially all. There was Keefe, McKay, Rugel, that all suggest that 80 to 81% could still be considered all or substantially all. There was also an informal ruling in Watts in 2004, which Justice Bowman, who's likes to be was very good advocate for taxpayers when he was a judge. He seemed to imply that it could go as low as 76%. being the all essentially all, which means 24 on your side. So because of these cases, the ability to base percentages based on numbers of rooms in the home, based on the CRA's positions and how you calculate, the CRA seems to be accepting of up to about 15% without a lot of pushback in respect to principal residence exemptions. I would submit, though, that if you go beyond the 24% as suggested in Watts, you're doing so at your own risk. Okay, so the moral of the story, if you're using a bedroom as an office, using your garage as a workspace, renting out 1 or 2 bedrooms, you're probably okay. If you're claiming more than 25% of your home for business purposes, you might be putting yourself at risk at losing the capital gains exemption on part of the sale of your home. Now, obviously, that's going to be a case-by-case basis, and you're saying, Corey, I have the perfect case as to why that wouldn't be the situation. I'm just saying that it's somewhere between 10 and 40. And I think 24 to 25 is probably as far as they're going to willing to go without challenging it. Doesn't mean you're not going to get it. It just means they might be a bit of a fight, might be a bit of an uphill battle. If you claim depreciation on your home, even just $1, you've lost the exemption for the portion that was related to that income from the business or property. So do not, under any circumstances, claim depreciation on a house that you live in or that you think you will live in. So if you're going to be renting out a property and you want to have a bit of a deferral for when you convert it to where you actually are living in it and not have a deemed disposition, don't claim depreciation on the house. There's some rules in there that allow you to, that's a whole other topic for a whole other day, but there are some rules that allow you to defer the change of use from a gains perspective if you elect, and if you convert an income-producing property to your residence, as long as there was no depreciation claimed on the property prior to you taking it as your residence. So that's quite common why you won't see a depreciation claim on rental properties, is to leave that deferral available, and there's other tax reasons for that as well. But I digress. At the end of the day, the social media stuff that you're seeing, the hubbub about, oh my God, we have to report our capital gains, or report our dispositions of our homes. Nothing's changed. They're finding a way to try and target those who are abusing the system, which is what we want. Those that are abusing should be paying more in taxes, so the rest of us don't have to pay their share. For CGL Strategic Business and Tax Advisors, I'm Corey Litzenberger, and I hope IT is going to have my stuff up and running pretty soon and get back into tax season. Thanks.